Hi, this is Daniel, and you're watching Unrivaled Investing. This is a no hype financial channel. We are focused on the fundamentals of trying to find potential multi-baggers. We are mission focused on finding exceptional companies and unrivaled investments. Today, we are looking at the Very Good Food Company. The ticker is VERY if you're in Canada or if you want to buy on the Canadian exchange, or VRYYF if you're looking at the US version. There are several subscribers on YouTube as well as Unrivaled Investing Journey brought it to my attention, knowing that I like learning about potential multi-baggers. This stock has gone parabolic over the last couple months, and their recent revenue growth of 400% definitely got my interest. But before digging in, if you like learning about potential multi-baggers, make sure you subscribe. If you're already a subscriber, I appreciate the like. It helps the Google algorithm. Also, if you want to follow my personal journey to find these types of multi-baggers, go to unrivaledinvesting.com, click on Journey. Also, love it when you post a comment below the video saying, hey, Daniel, love this video. Check out this next company. I think it has an unrivaled value proposition. Here is why it's going to grow in the future. Check out this company, and I will check it out. I'll add it to the list. So what is the Very Good Food Company? They go by the brand The Very Good Butchers. Their mission is to employ plant-based food technology to create low-processed products that are delicious and maintain a wholesome nutritional profile. Yum. So honestly, it looks pretty good. You got these awesome looking burgers. They got these cauli wings, smoking bangers, and pepperoni. Honestly, I don't know what smoking bangers are. And this pepperoni, maybe it's just a geographic thing. I'm more of an In-N-Out sort of guy, but I definitely recognize some people love, their vegan products. So, great. God bless. This definitely does look good. Don't get me wrong. If it were real meat, I'd be, And then they also have a clever strategy of trying to get interest. They recently partnered or had a collaboration agreement with Pamela Anderson. A lot of young boys, their heart rates just went up a little bit. That said, I might be dating myself a little bit with this. Who's the current Pamela Anderson? How old is she? And so they did a collaboration with Pamela Anderson, to raise awareness for plant-based diets and animal welfare, where she has, a Pamela's Charitable Foundation, which focuses on those causes. So, it sort of goes hand in hand. You have a plant-based food company, plant-based meat company, and, a charitable foundation focused on animal welfare and plant-based diets. So what else do we have here? So, the question is, do they have 10x potential? And yeah, they probably do. The global plant-based meat market, they're saying, is worth at least $10 billion now and could be $30 billion within the next few years. So huge. And we're talking about a microcap company. So when you're looking at a microcap company tapping into a much bigger market, automatically gets like people going like, whoa, this could be interesting. Let's keep going. So they also talk about, hey, we are expanding our capacity. In the third quarter, we closed on a new 25,000 square foot facility, fully built out food production facility, and it's real close to a key logistics partner. So that makes it easier for them to not only scale up, but to sell more units. And their phase one of this facility is nearly 500,000 pounds per week, which is an increase of 68 times their current production volume, which is huge. So you should be asking yourself, well, do they really need to increase their production volume that much? And they're saying, look, their goal is to significantly increase production capacity, accelerate U.S. expansion, because right now it's primarily a Canadian company, and meet current demand and allow for future growth. So this is, when you see something where a company's making the steps to expand by 70x in the next year or so, like that should bring a light bulb like, whoa, there's a lot of potential here. But let's dig in a little bit more. So they also announced recently that their demand for their products, the Stuffed Beast, is just out of control. Orders for vegan holiday product, the Stuffed Beast, have grown to record levels in 2020, with pre-sales for both Thanksgiving and Christmas at maximum capacity. That's a picture of the Stuffed Beast, and I'm glad some people think that looks really good. These orders include 2,000 units for Thanksgiving, 4,500 units for Christmas, and additional 1,500 units sold direct to consumers online through the company's e-commerce store at verygoodbutchers.com. The pre-sales represent greater than 300% annual increase in units compared to less than 2,000 units sold during last year's holiday season. So you're talking about, several thousand units being sold. And the Stuffed Beast has an average retail sale price in stores of approximately 44 Canadian dollars. That's a really important number for you to think about, because we're going to come about something about their pricing in a minute. And so then look, the CEO, Mitchell Scott, he's saying, we're delighted to see not only record demand for one of our most popular products, but continued repeat orders from key partners, Whole Foods and Sobeys. As we look to, I don't know if I'm pronouncing that right. As we look to expand across their large combined network, the robust sales velocity we are experiencing at the stores we're currently in gives us a lot of optimism for the future. So they're effectively saying, like, we're just seeing incredible demand, hundreds of percent demand, increase in demand. They're just trying to deliver, what they've got for the stuffed beast and other holiday products. And the stock price, you look at all these things, Pamela Anderson, you got a product with huge demand. A lot of people like the stuffed beast for the holidays. You're tapping into a huge market, general market awareness, and the stock price has gone right through the roof, up several 100% in just a month or two. But then there are some concerns. But first, wait a second. So there are concerns, but their revenue growth is doing great. Like this is the reason why the stock price is up so much. It's up, revenue in the second quarter was up nearly 400% in the second quarter, to $1.1 million. What? $1.1 million. This is a nano company. This is teeny tiny company. 1.1 million in sales. That implies annualized revenue of $4 million. So like any figures you think about, like you need to base it on what's the reality, which is like 4 million today. Annualized. And then you see this growth, and most of this growth is in this light green bar, which is their online sales, just going, nearly 8x across 2 months from February to April. And they're like, hey, COVID-19, that's what's driving it. March 2020, that's the reason why you're seeing this bump, and plus production capacity increased. But is COVID really the driver, the jump? Like, are people staying at home because of COVID and they're like, I just need some stuffed beast. Like, I need the beast, feed the beast, because it's COVID. Like, they got nothing else better to do. So you're shopping for the vegan beast. Like, is that what's really driving their growth? And the answer is no. So they say in their filings, and this bothers me a little bit. Like, this is what they have in their presentation. This is what they have in their filings. You always got to read the filings. The increase in revenue for the 3 months ended June 30th, 2020 was mainly due to an increase in e-commerce store sales associated with an e-commerce partnership agreement entered into during March 2020. What? So they entered into an e-commerce partnership agreement? And that's what drove there's no mention of COVID. They're saying, oh yeah, it was our partnership agreement. You could have put something like that on this slide. Effective March 2020, the company entered into an e-commerce partnership agreement whereby the company engaged a marketing company to increase the company's customer base through various marketing channels, including but not limited to Facebook, Instagram, email, and Google Ads. The services will be performed on a performance basis wherein the marketing company earns $60 per initial sale plus 10% of recurring revenues. Holy smokes. Like, we just said the stuffed beast cost $44, and they're saying they're paying out a marketing company $60. Help me understand the economics on that. 40 is less than 60, last I checked. So you're effectively banking on these people just loving the beast and saying, hey, we want to get more in the future, or having their subscription boxes. Someone signs up for the big box of plant-based meat, they pay $76 a month, and then, they make up for it on the second, third, fourth month of their subscription. Maybe that's how this is working out. Maybe that's the economics here. And, the agreement may be renewed for successive 6-month periods unless either party provides 30 days notice to the other party. Bothers me that that's not like front and center here of what's driving it versus calling out COVID. But okay, so the real growth is because they're effectively spending a ton on marketing, and they're effectively, their margins are going to be a lot lower because of this. And it bothers me, like, why are you doing this versus building out a long-term solution? See, this makes me think management is short-term oriented versus long-term oriented. Are you looking for a short-term fix, or are you looking for long-term fixes? Because a long-term fix would say, hey, you know what? We need to raise money, and we need to build out a long-term sales force. We're going to hire a head of sales who's going to know how to do this marketing. A head of marketing that's going to do this. That way you can oversee and call out like if any of these marketing initiatives are right. That way there's no agency problems. Here it is, you're hiring this outside party to do marketing for you. And if you have someone that's doing outside marketing for you, their incentives can be different. Their incentive is just to get people through the door for that initial $60 sale. They could put up marketing materials that you might not like. We'll get more to that in a second. Agency problem. Also, some other concerns. The stock has sort of gone parabolic because it's gotten a lot of people's interest. Fox Business, the Pamela Anderson news, Vegconomist. I've never heard of Vegconomist before, but I assume it's real publication. Motley Fool. Motley Fool loves talking about these. Is this the next Amazon? Always comes across as super shady when they do that. And most recently, the YouTube influencer Jeremy Lefebvre with his 500,000 subscriber account by the name Financial Education. This is on YouTube. And so honestly, it's a little concerning when you have a YouTube account with hundreds of thousands of subscribers sort of saying like, hey, this could be the next big vegan food company. So it's sort of hypey saying like, this could be a company worth billions of dollars. I'm getting it on the cheap. And by the way, I know there are hundreds of thousands of you that might just buy it based on me calling it out. In which case, and by the way, it's a nano cap company. So hundreds of thousands of people getting into it could easily jack up the price in the near term. Like, this sort of stuff bothers me. It apparently caught the interest of a lot of people because the company had to put out this press release saying the Very Good Food Company issued statement regarding promotional activity, calling this out, saying, hey, we don't have a relationship with any of these people. In addition, no financial consideration was paid in connection with this content. That's an important comment because we'll get more into that in a second, because they do pay for some content. They say like, look, we actually do pay a third-party investor relations provider, Future Money Trends. This is not an investor relations provider. That is like such a shady way of describing what they do. Go to futuremoneytrends.com and you'll see it's a bunch of like, silver is going to the moon. This is what the Joe Biden presidency, like doom and gloom. Like, this stock is going to be the next Amazon. Like, that's what this Future Money Trends site is. And they have been hired by a Very Good Food Company to use their newsletter group, blast out news publications. That's, it's promotional materials about the plant-based food market, huge market, the development of the company's business, and its recent operational activities. Now, remember when I said when you hire a third-party company that's outside of who you are, so third party, you create agency problems because their incentives are going to be different than yours. So here it is. If you have an agency where it's like their incentive is maybe to get the stock price above a certain level or, see how many new investors they can attract to the stock, they put out promotional materials that has been determined contained a materially false statement with respect to the company's proposed facility in Patterson, California. The company wishes to clarify that while Very Good Food Company has secured a lease for the Patterson facility, it is not yet operational at this time. So here is like they were promoting like effectively a lie in their letter to presumably thousands of potential investors. So like, there's a lot of stuff here that makes me sort of queasy. I don't want the beast in my tummy. I don't want that type of queasy. But we should be able to ask and answer like, why does a company need a stock promoter? Why do they need to pay a stock promoter? Like, wait a second. If I'm a shareholder in a company, why should shareholder funds that I could be receiving go to pump up the stock? This doesn't make any sense to me. And why hire a stock promoter? And they didn't have enough cash relative to their cash burn. Like, as of June 30th, they were at $2.5 million annualized cash burn versus their cash balance of $3.5 million. So within a year or two, they would be toast unless they raised money. So they needed to raise money. And if you jack up the stock price with short-term initiatives like, hey, let's sell more units or let's hire a stock promoter, if you do something like that, then management gets to keep more of their pie. So instead of getting a teeny slice, they get a big slice. Because there's less dilution, because it's a higher stock price that they can sell at when they're raising capital. I think that's sort of an aggressive way to think about it. The more conservative take is that the company needs money to stay alive. Like that's a realistic take. Like within a year or two, if things stayed the way they were, you'd be out of, you'd have a liquidity situation. So they desperately needed funds, in my opinion. and they raise the cash. That's what the stock promotion sort of activity is for, is like, hey, let's get interest and raise stock prices over time. And in August, it was raised at $8.5 million. This was upsized from their initial target of $6 million. And Canaccord, the banker, got 8% of the proceeds. That is pretty rich. You can see banker fees from 4 to 7%. 8% is pretty. So bankers got to get paid. The game got to keep going on. And that bumps up their cash balance, which relative to their cash burn, gives a lot more, breathing room. But you'll probably see some sort of accelerated cash burn. So you might go from $2.5 million annualized cash burn to more as they bring on these new facilities, because they're looking to expand their capacity. Increasing your capacity by 70x isn't free. It's going to cost some money to build that up, and some of it's going to be underutilized for a little bit. Oh, and that's not all. So there also, been some insider selling where after inquiry by management, the company confirms that its officers, directors, controlling shareholders, and third-party service providers have not sold or purchased the company's securities within the past 90 days. Great. Other than Mitchell Scott, the company's chief executive officer, who sold 140,000 shares across October. In honesty, this bothers me a little. If you really think this company can increase its production by 70x, let's say this next decade, then selling shares now is a really bad investment. It reminds me of a friend who bought Apple stock, and then his wife wanted a new kitchen, and he was like, man, I don't have enough cash. We have to sell some of this Apple. And his wife's like, look, I want the new kitchen. So he sold the stock, and it was like 2009, 2010. And he's like, wife, this is the most expensive kitchen in the world. Look how much Apple stock is worth now, but we used it for this kitchen. And I sort of feel like that story is probably appropriate here for Mitchell Scott, the CEO. But in fairness, he does own 14 million, shares outstanding. So it's not a huge position. It could be he just wants some more spending cash. I understand. And he still owns about 15% of the company. But look, it's not all bad or fluff. Like they did announce a new distribution partner with UNFI Canada, where they're going to sell their products across Canada, and UNFI has a relationship throughout North America. They're one of the largest wholesale distributors, with over 21 billion in revenue, 40,000 retail partners. So in terms of getting their foot through the door, this is an important relationship for the Very Good Food Company to have. And the Mitchell Scott says the distribution agreement with UNFI is a particularly exciting achievement for us as it opens up the potential for significant expansion across North America, utilizing UNFI's vast distribution network. This makes sense. The increase in distribution is limited to the production volume out of the current operational Victoria facility, with additional volume coming online in 2021. i.e., look, we'd love to grow with UNFI, but we just we're at max capacity. You saw that 400% demand? We are tapped out. So we need to dramatically increase our capacity. And when we do, we're going to have the relationships in place to increase that sales. So that's exciting. Like, this is not all fluff. What about my thoughts on the valuation? 94 million shares outstanding, currently around $4.40 a share Canada, $3.30 US. You can see the respective tickers vary in Canada, VRYYF in the US. That implies about 400 million Canadian, 300 million US. But to put that in context, they're only doing around 4 million annualized revenue right now. So 100 times sales. That's pretty rich, like 100 times sales. Whew, this is like snowflake valuation here. Like, damn. And this isn't a software company with Warren Buffett's backing. And so you can see, like, hypothetical 2021, maybe, like, I'm throwing some mud on the wall. Like, maybe they triple again next year and they're at like 15 million in revenue. That's more than tripling, given that, that I'm using an annualized figure for third quarter. And you assume operating margins of 15%, that could be a lot lower given their marketing arrangement. Like that operating margin could be like 5%. Might even be negative, like just given the structure. Like they're selling the beast at 44 and the cost is $60 for the first sale. But I'm just like, hey, let's just assume 15% operating margin on hypothetical 2021 sales of 15 million. That gets to an implied 200 times earnings. That is pretty rich. And just to put this in perspective, like if you have a company that's worth $400 million, let's say you have no prospects for growth, the exact opposite of the Very Good Food Company, like thinking about valuation, the exact opposite. And all they do is return cash to you. That's all they do. And so if you're at $400 million, like what's the cash yield that you would need to be comfortable owning it at a $400 million valuation? Well, I would say like in this interest rate environment, assuming you're saying like this company is going to be super stable over time. It's a consumer goods product. Like assume it's going to be super stable, no growth, no decline. I'd say maybe a 5% yield in this environment. Interest rates can go higher. So a 5% yield on $400 million valuation implies you would need to have $20 million in dividends going out to shareholders. Keep in mind, I'm doing like a hypothetical exact opposite of Very Good Food Company. What if you had no growth? So if you had 20 million in earnings, that would mean you need to have about 200 million in sales to justify that valuation. Because 200 million in sales with 10-15% margins, slap on some tax, gets you to 20 million in profits that you can distribute. And that gets 20 million on 400 million market cap, gets to about a 5% yield. So you're effectively saying that they're going to be able to deliver on getting to from 4 million in revenue to 200 million in revenue. And your upside as a potential shareholder is their growth from there. Because the valuation is currently saying like, look, if you get to 200 million in sales, that supports 400 million valuation. So if you're buying it and you're saying like, yeah, I think this could be billions of dollars, you're saying, I think the revenue is going to go way beyond 200 million in the years ahead. This is a company that did 1 million in revenue last quarter. So that is pretty rich. That's a big assumption for people to be baking in. The question then becomes like, how sustainable is their growth? What's the risk they don't have enough cash currently to scale, like to get these facilities up and running? Because it costs money to set something up. You don't just start minting money right away. Do they have the operational prowess or the logistics capacity to handle this? For example, a lot of their behavior reflects really short-sighted behavior. Hiring the stock promoter, hiring the marketing, the third-party e-commerce network versus in-house sales and marketing. So, I mean, if you get the logistics wrong, and you start selling something that, maybe hasn't been triple checked and maybe the beans aren't ripe or something's not right, you don't want, you can eat the beast, but you don't want the beast in your stomach. What are my concluding thoughts looking at the Very Good Food Company? And look, so the valuation's super rich. There's been a lot of hype. You got hype on YouTube. You've gotten hype by the stock promoter that they've paid. You've got hype from an e-commerce, side where they're getting $60 for each sale. And so then the last component is like, how do you justify their growth? Because if you're buying the shares today, you're effectively saying, I think they can do more than 200 million in sales in the future. So if you're saying that, you need to like be certain that they have the value proposition to deliver. Do they have an unrivaled value proposition to deliver that type of growth in the future? And the problem is like, look, there are so many plant-based meats out there. I mean, that's what they're offering. You got Awesome Burger, Impossible Burger, Beyond Burger, Pure, Uncut. Like, I don't have enough of a see-through on this, the Very Good Food Company, the Very Good Butcher, to say like, oh yes, you taste that much better. You're going to be able to beat out all these billion-dollar companies, these companies that have already rolled out into these stores. Like, and if the unrivaled value proposition isn't clear to me, you better make up for it with a lot lower valuation. And that's not the case. You have both unclear value proposition relative to these players and a really high valuation. Like I can deal with an unrivaled I can deal with a value proposition where it's like, they're still figuring it out. There's a good chance they get there. There's a good chance they get a really strong value proposition where they take share over time. But, But you need to offset that with a really cheap valuation to sort of guarantee or increase the odds that you have a good return. Like that's what you need to do. You always need to factor these two things, like value proposition versus valuation. Like if you're super confident on value proposition, you can pay a much higher valuation and still get an adequate return. But if you're not sure about the value proposition relative to these competitors, then it starts getting a little tougher. I would say it's definitely not the case here that you're getting a cheap valuation. That I can say very confidently. If you want to see what I am personally buying, what are the potential multi-baggers that I am looking for? The types of companies where I think, look, you are going to be able to take share each year and you have a relatively attractive or reasonable valuation. Then you get sort of this appeal of like, hey, you're going to win over time. And that's what I'm looking at in my personal financial journey. You go to unrivaledinvesting.com, click on journey. You can see what I buy, what I sell, what I hold. There's exclusive content below this video in the description. I'll have all the links to the videos that you can click on if you become a subscriber to, the content that I'm putting out there. And, I aim to identify multi-baggers each month. And the reality is finding just one potential multi-bagger can change your life journey. So if you're interested in following my journey to find these multi-baggers, go to unrivaledinvesting.com, click on journey. And if you enjoyed this video about the Very Good Food Company, please make sure you subscribe. And I really appreciate seeing the subscriber count go up after each video. I also really appreciate the thumbs up. It helps with the Google algorithm. And thank you so much for watching.